What's better, paying off your mortgage, investing in shares and stocks, or putting your money into property? While lots of YouTubers tackle this question, from Dave Ramsey to Damien Talks Money, the money rules in the United States or United Kingdom are very different to what happens here in New Zealand. So today, I'm going to figure out which one is the best investment. I'll start by looking at the returns, and once we've compared the risks, then we will finally know who should put their money into each type of investment. But just before we get to that, you need to understand that these three investments, they're not the same. So what happens if you have $100 a week and you put it into each of these? Well, paying off your mortgage is a bit like an apple. It's simple. It's widely considered to be pretty good for your health. So let's say you own a house and it's worth $500,000 and you got a $400,000 mortgage. Well, you then have $100,000 of equity within that property. Now, let's say you pay an extra $100 a week and you put that against your mortgage. Well, your debt drops to $399,900 and your equity just went up by $100. Now, getting debt-free, that can also feel really emotionally rewarding because you know that you are slowly getting closer to being completely free from the bank, and once you get to that point, you'll have way more money to spend on your day-to-day life. But while every dollar you put into your mortgage is a dollar added to your net worth, you're not buying anything new. You just have more wealth in an asset that you already have. Now, that is very different from stocks and shares, which is a bit like an orange. And the reason is because when you invest in stocks and shares, you are buying a tiny piece or pieces of much bigger companies. And I do mean tiny. For instance, if you buy one of Apple's 14.78 billion shares, well, congratulations, because you are officially a minor shareholder in one of the world's largest companies, because you own 0.00000000677% of the company. And as those companies grow, your share in it becomes more valuable. And if the company pays out some of the profits as a dividend, you get a teeny tiny portion of the profit, in this example, on every iPhone sold. Now, most Kiwis won't sit there picking individual companies all day. Instead, what they might do is they'll chuck $100 a week into an index fund or a managed fund. Now, that's just where an investment expert, a fund manager, gets money from lots of different investors, and they choose the shares, the properties, and the other investments to put your money in. And every week, as you put your $100 in, you're buying an asset. You're actually buying more units in that fund, or if you're investing in shares, you're buying more shares, more segments of the orange every single week. Whereas, remember, with debt, you were creating more wealth in the asset that you already own by paying the debt down, yes, but you're not buying extra assets. And that's why, as I said, paying down debt and investing in shares is a little bit apples and oranges, because they aren't doing quite the same thing. They are a bit different. And with shares, your portfolio is often made up of lots of little segments, just like an orange. And then you've got property. Remember, if you put $100 a week into shares, you're slowly buying more assets over time. But with property, it's actually the opposite. You usually borrow a lot of money up front to buy one big expensive asset. And if you use the no cash needed method and buy it without a cash deposit, the rent probably won't cover all of the costs. So you might need to top up the property by that $100 a week. Now, with shares, that $100 a week is going to buying little segments to grow your portfolio every single week. But with property, if you're topping it up, you buy the big fat asset straight away, and it might go up in value, but your $100 a week isn't going to buying more assets. It's often going to keeping the asset going. And that is why property is a little bit like a big fat watermelon. Now, can you compare apples, oranges, and watermelons? Yes, you can. After all, they're all fruit. But they also have their own unique features, which makes it a little bit harder to compare. But now we know what each of these assets actually are. Let's compare the returns and then the risks before revealing who should invest or who might like to invest in each of these different assets. And if you're enjoying this video so far, do me a quick favor and hit the like button, because that's how I know which of these videos to do more of. And honestly, it really helps the YouTube algorithm. While you're down there, make sure you hit subscribe so you can see more of these videos. And if you do already subscribe, you'll know that we can't just compare which asset has the highest return. We've also got to look at how much of that return you actually get to keep. So if you think about paying down debt If your mortgage interest rate is 5% and you pay an extra $100 off your mortgage, that saves you $5 in interest over the next year. Now that is a real saving. That is a 5% return per year. But if you compare that to putting money into, say, a term deposit, imagine you're standing outside a bank and you see them advertising a 7.5% return for a term deposit. That might look really good compared to only the 5% return you'd get from paying down debt, but actually they're the same return. Because if you invest in a term deposit, you could lose a third of that income to the tax man, depending on your tax rate. So the return you get is not necessarily the return you get to keep. And that's why you always want to look at your returns on an apples for apples basis, looking at the after fees, after tax returns. And that's really useful to know once you come to shares, because over the long term, shares and managed funds, they actually tend to have a higher average return than just paying down debt. Let's say your shares or your fund averages 10% a year before fees and taxes. Now that sounds really great, but once you strip out fees, which might be 0.5% to 1.5% to the fund manager, that return could go down to say 9%, and then tax could take out another 0.5% off that. So it looks like a 10% return, but the return you get to keep might be 8.5%. Now that is still a very, very good return. Now, once you get to property, that's where it gets interesting, because let's say you want to buy a $500,000 property and the bank is going to lend you $400,000 as a deposit. But then you've got to put in some of your own money, in this case, $100,000 as a deposit. Now, if the property value increases by 5% per year, the house or the property is now worth $525,000. Now, what does that mean? Well, it doesn't increase the value of your mortgage. Your mortgage is still the same, it's $400,000. But that house price increase, that doesn't go to the bank, it goes to you. And now you've got $125,000 worth of equity within the property rather than $100K, which you had before. So any house price increase goes straight to you. Now, it's a 5% increase in the value of the property, but remember, you only put in $100,000, and so that is a 25% return, at least on the money that you put in. The property only moved in price by 5%, but because you used the bank's money to buy it, you actually got a much larger return because you're getting a return on the bank's money as well. Now, it does also go the other way. That's the power of using debt when you invest, which is also known as leverage, which is basically the effect we talked about before. You're starting with a whole watermelon rather than buying a small orange segment per week. So paying off debt often has the lowest return. Property is actually often in the middle, and shares get the highest percentage return. But if you borrow money to buy the property, like most investors do, then putting your money into housing can often get the highest return, at least on the money you invest, and that's based on the assumptions here. But you could easily fail in investing if you only think about the returns and don't understand the risks, because if you only invest in property and take on lots of debt to do it, there is a decent chance that you could go broke and lose it all. So don't roll your eyes at me when I start talking about the risks, because in investing, when we talk about risk, we're often not talking about the chance that your house burns down, even though that is a risk. Instead, risk means how bumpy your investment journey is. Does the value of your investment go up and down a lot, which is what we call higher risk, or does it gently go up and down more slowly, which we'd consider lower risk? Now, risk-wise, paying off debt is the least dramatic. If you look at the last 20 years of mortgage interest rates, they don't change much. Most of the time, they're between 2 and 10%, and often somewhere in the middle. And on top of that, reducing your debt often lowers your risk. But that also doesn't mean that paying off your debt means no risk at all. Because let's say you're paying down the debt on an investment property. Well, in that case, as we said before, you've got more of your wealth tied up in that specific property. And that introduces a new type of risk, which is called concentration risk. That's when a lot of your wealth is tied up in a single asset. But all things considered, paying off debt usually considered a lower risk use of your money. Now, when it comes to shares, your wealth is going to bounce around a lot more. there is about a 1 in 6 chance that the S&P 500 drops by 10% or more in a given year, and there is also a 1 in 6 chance that it goes up in value by 20% or more in a year. So even though it might average out to an 8 to 9% return, at least in my numbers, sometimes it'll spike and other times it'll drop pretty aggressively. The risk with shares though isn't just that the number goes down. The real danger is that you see your investment account drop by 20%, you freak out, and then you sell while share prices are down, and that turns your on paper loss into a real one and could mean that you miss the rebound. And while that's scary, property is actually much worse, because if you have a mortgage on your property, everything gets magnified. Sure, if you put 100K into a $500,000 property and you get that 5% increase, you just made 25 grand. But what happens if property prices fall and you lose 25 grand as well? So it makes the returns a lot bigger, sure, but it also makes the losses a lot bigger as well. And the other thing you've got to think about is while property tends to go up in value over time, you might lose money if you're not able to hold on to it for the long term. So what happens if you've got to sell it in a downturn, or you and your partner split up, you go through a divorce, a job loss, or just some bank pressure and you need to sell it at a time where the market's not going so well? Well, that's when people get hurt. But there is also a hidden risk in property, which is all about cash flow. So with shares, you might put $100 a week into your investment account, and if times get tight, you can just adjust the amount you put in. Maybe you only start putting in $50 a week, or you stop putting in money at all. But with property, that same $100 a week, it might not be optional. You can't just decide to not pay your rates, insurance, maintenance, or mortgage if the rent isn't covering all of the costs. So property can mean high returns, especially if you use debt, but it can also mean a much heavier commitment. So if you're going to do it, you need the time to be able to stomach the ride up and down. But when it comes to the risk, paying down debt is usually the lowest risk. It's not zero risk, but it's pretty low. If you're investing in property without debt, it's actually a similar risk to investing in the S&P 500. But if you're investing in property with a big mortgage, that's like putting your money into a single high growth tech stock. So it's going to be way more up and down. And that's again based on these assumptions here. So which one is the right one for you? Well, each asset is actually going to help you achieve a slightly different goal. So if you're older and your number one goal is to be mortgage free before you retire, then paying off debt, that might be the most appropriate choice for you. If you're thinking, I'm not sure what I'll be doing in 5 to 10 years, I might want to start a business and have some money available for that. Maybe I want to upgrade the house. Then putting your money into stocks or shares, that could be the right move for you. Or if your goal is for long-term wealth creation, you're happy to hold through some big ups and downs, then property could be where you start. But the honest answer is that you're probably going to do all of these things over your lifetime. Early on in your life, you might invest in KiwiSaver and funds to build a house deposit. Then you might buy a house and you might focus on paying down the debt. Once you hit your 40s and 50s, you might invest in property, maybe some shares, before selling up the rentals and putting it all into a fund while you're in your 60s and 70s. Now, obviously, I'm not telling you that's exactly how your investment life should go. After all, this is a YouTube video. This is not me giving you formal financial advice. And remember, I'm an economist, not a financial advisor. But if you want some financial advice, you might like to book a free session with one of my 12 financial advisors. They use the forecasting tools that I've created to show you what your retirement and your financial future could look like. So if you want a clear, personalized plan, make sure you book a free session with one of my advisors and we'll work it out together. I'll drop a link down in the description. And if you want to figure out if using a financial advisor is even the right fit for you, make sure you watch this next video where I share if property investors really do need a financial advisor, and that includes the 7 signs that you might need one and the 7 signs you really don't. See you in the next one.